Concessional financing or interest rates below those available in the market will come from World Bank, International Monetary Fund and the African Development Bank. Brenda Kerubo with the details.
The International Monetary Fund will give Kenya at least $410 million or 44.1 billion shillings by the end of June 2021. This is after IMF finished its first review of a 38-month program where government officials pledged to manage spending, fight corruption and address debt vulnerabilities.
So this has always been our objective all along, and we have been working on it for quite some time. So to claim that it is an IMF, is an objective of the IMF program, well, we just threw it in there. That we said and that we are committing to do this.
The government will also receive $750 million or 80.6 billion shillings from the World Bank in the next 2 weeks and an undisclosed amount from the African Development Bank. National Treasury is in dire need of the additional loans to bridge the fiscal deficit, estimated at 952.9 billion shillings in the financial year 2021-2022. But it is expected to put a strain on debt servicing, which is expected to reach 1.599 trillion shillings in the financial year 2023. Kenya applied for debt suspension in January this year from China and under the Debt Service Suspension Initiative. Treasury estimates 78.17 billion shillings by the end of June 2021 could be saved. Debt suspension, while favorable to the current financial year, could result in servicing pile-up over the medium term, a pattern tipped to affect our debt to GDP ratios.
Kenya's interest in extension of DSSI debt relief, the answer of course is yes. Why? Because it will free resources that can be used for other purposes, and in particular the recovery or supporting the economic recovery program, that is post-COVID recovery program.
The external debt sustainability indicators indicate Kenya's risk has increased from low to moderate, but government says it is short-term as it continues with its fiscal consolidation reform and restructures short-term commercial loans by replacing them with long-dated maturities. Brenda Kerubo, KTN News.
Well, I want to bring in Ken Gishinga. Ken, looking at the numbers that we are getting from the CBK governor and the moves that are being taken in regards to our economy. Looking at the fiscal deficit, first of all, being projected for this coming financial year, we are almost hitting a trillion mark, all right? 952B estimate. And debt servicing, 1.59 trillion by the year 2023 when we project. I mean, balancing this, where are we heading as a country? Are we on the right path?
Well, no, it's crystal clear that the national government is badly in need of cash. And the way you can tell this is when you look at the non-performing loans in the banking sector, which came out earlier this week. We're about 14.2% in terms of non-performing loans. So that tells you that businesses are struggling to raise money, they're struggling to service their loans, and that's the reason that the government is going out there to borrow. Now, that said, they have to have a long-term thinking in terms of how do you service these loans? How do you come up with a good tax framework that can raise revenue to service this debt? Because right now what you're seeing is everything is being taxed, from fuel to infant milk to Netflix. And that is creating a sense of disaffection for public policy. So I think it's a time the government thinks about its taxation policy and how sustainable can it be to be able to service that long-term debt.
Definitely. Wahorundoho, let me rope you into this discussion. We've seen also our risk, external debt sustainability indicator, our risk is going up. We are borrowing more, our budget is going higher, our revenues are constrained. How should the government react in this place, you know, between a rock and a hard place?
Well, one of the things that it's clearly done is look at the entire debt portfolio. And you've seen that, I think we've said this several times, that the fact that they've gone to refinance their commercial loans with a longer maturity means that they're extending into the future, what are going to be due very quickly. But beyond that, I think most of the critical measures that need to be done are already in place. The question is that in the intervening period between restructuring your debt, that you can't do that overnight because you have to negotiate it. Now that they're in the process of negotiating that, you'll notice there's a very, very strong push towards concessional loans. And I see here that's an interesting dynamic here is seeing the World Bank and the IMF quietly sort of come into the picture to help us, in a sense, move our debt portfolio more towards a concessional and find ways of giving us some breathing room so that we can restructure the entire portfolio towards one is longer maturities in this commercial, or refinancing it with a lower costing debt. Either way, I don't think it's going to be a short-term solution, because like I've said many times, we've been in a 20-year building spree in this country to build our infrastructure. And just about any country that's done that has gone through something similar to this. To my colleague's question about a long term, yes, certainly there's a question about taxation. And of course, in economics, is this thing we call the Laffer curve, which has to do with the incidence of taxation. At what point is a tax regressive? In other words, you can tax people to a point where it's no longer helpful because they just become creative in avoiding it. And I think that's a dilemma that the government has. When we talk about refinancing our debts, we also have to talk about revenue. And finding that balance, I think, is where the hard work is being done. And I think you could always argue you could do more, but we're definitely on the right track because commercial loans are out and they're not going to be in for a very long time, I don't think.
Definitely, that's very important. Also saying, earlier on when the pandemic was just kicking in and DSSIs were coming into effect, we saw, Kenya taking a backbench in that regard compared to some of our peers. But we've seen a turnaround in that regard. Maybe, Mr. Ndoho, this change of attitude towards DSSI, is it something that is going to be consistent moving forward?
Well, you would expect so. I'd like to also point out that increasingly, a lot of planning has to do with scenarios. And one of the scenarios that you have to put yourself in the seat of the policymakers is they're looking at a future in which the African continental free trade area comes into place. We are also in a place where we've created an infrastructure asset base that gives us the opportunity to now leverage our private sector, which is by far the most robust in the region, to really take off. So there's also the argument around this that there are opportunities for more revenue. I think in terms of our own revenue collection capacity, they're much greater than we currently are. It's just that it happens to have happened now with COVID-19. But I think I can see all the pieces that are being put in place for a Kenya that is very aggressive in Africa and producing revenues from a much more proactive stance in terms of our exports.
Definitely. And Ken, we saw just this week the MPC, Monetary Policy Committee, their statement maintaining the baseline, benchmark lending rate for the 8th time at 7%. Just looking at the policy environment and the way it's responding to the overall global economic, situation that we're in so far. How has that been handled? And taking note of the latest MPC released.
Well, in that MPC release, the governor tried to paint an optimistic view of the future. He tried to talk about stability in our macroeconomy, and really he tried to pacify the markets. But the numbers really contradicted him. When the banking sector is having non-performing loans at 14.2%, that's almost 3 times the recommended levels, and it shows there's some serious cash strain in the economy. And part of this is because people have lost jobs. About 2 million jobs have been lost. And what happens when people lose jobs? They don't spend. Even if they receive any form of secondary income, they don't spend because they don't know about the future. So you have this very high savings rate, very low spending rate, which is really curtailing consumption. So for me, the big question is, when will the Monetary Policy Committee start looking at unemployment and start giving Kenyans a solid picture of jobs? Because we were expecting to hear that 2 million jobs have been lost. The strategy to try and recover at least half of them, 1 million jobs, over the next 6 months is A, B, C, D, and this is the amount of liquidity that is expected. So I think that's the kind of heavy lifting that Kenyans are expecting the CBK to undertake.
Yeah, Mr. Doho, when we wrapping up this particular bit, just briefly, as Ken has noted, some of the MPC's outlook, they seem to be very positive. You read them, and everything is anchored well. We are doing well. Do you think it's out of touch with the reality on the ground for majority of Kenyans in this country?
Oh, I think the governor has an impossibly difficult balancing act. On the one hand, it is true that a lot of the numbers don't look good, but also, the financial markets is about confidence, and it's good to project a steady hand at the steering wheel of monetary policy. And so I think to a large extent, yes, I don't think he could not have done what he's done. The question to my colleagues' issue around employment, I'd like to also point out that in Kenya we are a two-speed economy. We've got the formal economy, and that's what people have lost jobs. But what we don't see much of is what the informal sector is doing. And I think between that, and if you look at the likes of Tala and those other online loan applications, they'll tell you a very interesting story about how basically people move from the formal economy into the informal economy. But don't have very good statistics to tell us the extent to which, for example, the 2 million jobs that my colleague talks about, have they been lost completely, or is it that people have just moved from the formal economy to the informal economy to survive, or even agriculture? So to some extent, there's a lot of data that needs to come out. And you have to say that there's something in our economies in Africa that even in this sort of disastrous situations, we seem to get on. I think it's time we found a way to bring them out into the lights, out into some sort of formal economic analysis to understand exactly how it is that, for example, after COVID-19, Kenya, most of Africa keeps running. So clearly there's something that's not being captured in our data. And I'd be very curious to see where we can get that data.
That's quite interesting, because today, as I was coming to work, I was checking Twitter, and one of the comments I saw, somebody was just, even when you're using public transport, so some of them you see there, do not usilipe na M-Pesa, all right? There's this element of fear of formalization. I don't know whether it's cost saving, that is one. But for the longest time, we've tried to bring, the informal sector into, for example, the tax bracket. Ken, I know you're very passionate about this particular issue. Are we approaching it the wrong way, or is there something that we can do to make sure and to make Kenyans want to be, come under that formal umbrella?
Well, I think the biggest fear has been normally around taxation. I think far too many informal businesses feel that if they sort of follow, they toe the line, the heavy taxation will almost make their business model not comply. So there's such a big incentive. But if we are able to use formalization to incentivize, to apply things like stimulus, see, like in the US, for you to receive that stimulus check, you had to be within the formal sector. You had to be submitting your tax returns. So I think when people are able to see first the value of paying the taxes, that it goes back to them and it's not plundered. And number two, they see that if there was a time for stimulus, those are the channels that stimulus would come through. I think you'd see a lot more compliance.
There should be some sort of motivation towards bringing people into this formal bracket. But trust you me, people are doing well in the informal sector. Somehow, when you walk around, as young people call them chwoms, ukunda ni ndani. You see people doing amazing stuff, and it's just totally contrast to what is happening overally, especially in the formal sector and what COVID-19 has done. Anyway, gentlemen, so we've talked so much about this particular issue, and before our time totally expires, because time is really flying, we've seen quite some interesting development. This is just for social commentary. We saw Dangote in Tanzania. We also have Safaricom in Ethiopia, but let's start with Dangote, because this is the richest man in Africa. A while ago, close to 3 years ago rather, he wanted to invest in Kenya. That didn't happen. Now he's doing that in Tanzania. I mean, Mr. Horondoho, what do you make of this? Dangote, Tanzania.
What a brilliant one. I think what he's telling us, the message to Kenya is be very, very careful, because if you talk about investment-friendly environment, it has to be open. There must be no impediments to people coming. And you cannot put vikwasos for people who are bringing investment into the country. And I think the second thing it says is that our regional partners have learned a lot from our mistakes. And we'll be well advised to begin to change tack in the way we approach investors. It's a pity that an African investor like Dangote would feel that he can't actually do it here. And so I think it's a cautionary tale for us to really get our act together as attracting African investors to our part of the world.
Definitely, that's very important. Anyway, gentlemen, I know it's Friday. You guys are busy, have plans for the weekend. So do I.